Welcome to Cash Talk, the podcast where we delve into the depths of finance, business, and life itself. I'm your host, John Casher, a multi-award-winning wealth advisor with a passion for empowering ambitious Australians to confidently achieve financial freedom. Hey everyone, before we get started, this is a quick reminder that everything in this podcast is of a general nature and nothing has been tailored to your personal circumstances. So please seek personal financial advice before acting on this information. And welcome back to Cash Talk. Today I'm joined by JK, where we're going to be talking about something that I'm sure all of you have thought about, which is the trade-off between do I put my money towards my debt and do I put my money towards investing? So JK, how are you, mate?
Good, mate. How are you?
Not bad. Looking forward to getting into this one because it's something that a lot of people talk about, a lot of people think about, and I want to kind of unpack how we go about things to, help people achieve their goals. Yeah. So, JK, obviously a lot of people are thinking about, do I put money towards investments? Do I put money towards debts? What are your first things when you're looking at someone? You've created that surplus cash flow, which is number one. What's your thought process? How do you go about that?
Yeah, so it's an interesting one. The first thing is around looking at their debt situation, because you don't want things like unsecured debts or debts with high interest rates, because at the end of the day, it's a numbers game. So if you're going to be earning, 9% on an investment over the long term, but then paying 12, 13% in interest, well, you're better off just putting the money towards paying off that debt.
So we're talking about things like personal loans, credit cards, usually.
Yeah.
These higher interest rate paying stuff.
Correct.
Yeah. Understand.
Correct. And then once we've got an understanding of that, well, then the next part of it is what are the client's goals? Because it could be a retirement goal. It could be when they want to be debt free, and then working within that to make sure that, yes, if we're going to be allocating some of this cash flow towards investments, are we still able to achieve their goal to be debt-free, their goal to retire comfortably and be debt-free once they're retired? On the flip side, you've also got the risk of allocating too much money to debt, because there's no good paying off your home loan and then being 55, 60, having your home loan paid off and then having no other assets outside your home, because as we know, the home that you live in isn't a cash flow asset. So then what are you going to use to be able to retire off that?
So it's very important that you understand goals, because you can then understand how future cash flows need to move. The other big thing that I think that people forget is that a lot of these debts are paid in after-tax money as well. So understanding the after-tax impact is very important, but also when it comes to investing, most people investments are done in after-tax dollars as well. And so this is why we like superannuation so much. It's around, even when you're young, obviously when you're older, it's much closer to retirement. It's much more better, because you're going to get access of superannuation. But superannuation, if done properly, is invested in before tax dollars. Yeah. So if you think about it, let's say your tax bracket's 30 cents in the dollar, 30 cents is coming out before you even play the game. Now, I know there's a 15% contribution tax in superannuation, but it's still much less than what you're paying in your after-tax costs. And in some cases, the contribution tax is only taxed at the end of the financial year. So you've got 12 months of no tax in that scenario. So, and that's obviously not for every fund. It's not under all scenarios, but in some cases that is the case. So I think the after-tax consideration needs to be done. And when you go back to what you said around understanding goals, do you want to retire when you're 50? So do you put all your money into superannuation when you're not going to have access to it? And then when it comes towards your debts, well, when you stop working, how much money can you outflow to liabilities as well? And then are you then forced to sell assets? Because this is the other big thing when it comes to debts. I see a lot of people accumulating debt, and then when you ask them, what are you going to do to pay it off? They're like, I'll then sell a property or I'll sell something. We don't like selling assets, do we?
No.
And why is that, JK?
Because, well, one, you've got capital gains tax, which is usually the biggest bill when you sell an asset. And then you've got transaction costs. And, if you're selling a property, you've got the agent fees. If you want to buy something else, you've got stamp duty. So we want to try limit transactions as much as possible, because it's that's where we start eroding at our wealth with these extra costs.
And I think there's the fact around timing. You know, when you're selling an asset, be it property, stocks, or whatever, how do you know what's going on in that year?
Yeah.
Is the market conditions down? Are you then selling at a loss? And then, so I think banking, paying off your debt in regards to that is something that should be heavily considered in regards to having other strategies towards that. Doesn't mean that you don't do it, but it means that you've got to think about other options.
Yeah, correct.
So how do you then build, like, let's say you've come to the idea where you can pay off the debt within the next 15 years for a client, and they can maybe retire when they want to, let's call it 60. How do you figure out how much, like, to start with? Like, how do you work that? What's your thought process?
Yeah. The starting is, I think it's a little bit more straightforward, to be honest. And the reason why is, especially when you're working with someone who doesn't have any investment experience, regardless of their cash flow to be able to invest, you're usually not doing 100% of what they can do at the start. So it's usually starting small. And that's more for them to get a feel for it, get an understanding, improve the financial literacy. Because what you don't want to do, which is the most expensive lesson, is throwing the kitchen sink at these investments, and then the client, you know, or the person that you're working with, not understanding how markets work and market cycles and all that sort of stuff. Market has a downturn. Oh, crap, I can't handle this. I want to sell. And then you're selling at a loss, and then you lose the opportunity to essentially make back those losses.
So, JK, are you saying that even when you look at the numbers, and the numbers might say you need to invest more or put into debt more, you have a view of, I've got to work on these clients' behaviors. These numbers aren't telling me.
100%.
Okay. And I've been working with JK since he was knee high to a grasshopper, but the reality is it is so true. You know, we go to the gym, you don't put 4 20-kilo plates on your bench press and then start going for it. You build yourself up, you put 5 kilos, 10 kilos, and then work your way, and you're trying to make sure that you don't get injured.
Yeah, 100%.
And you know, you're not making sure you try not to get financially injured. It's a marathon. It's not a sprint. And we find that by creating those behaviors, you then build the momentum for them to stick to it, because a lot of the models that we do are 10, 20-year models.
Correct.
The biggest hurdle is you got to make it to the 20 years.
Yeah.
Like financially speaking, you need to be disciplined to make it to there. So, you know, the difference between putting towards your debt, putting towards your investments is probably negligible in comparison to making behavioral mistakes.
Yep.
Okay. So that's great to talk about that. Now, when you talk about a debt in itself, if we get a little bit further into debt, we see a lot of people pay off their debt incorrectly as well. You know, even a client today, they were structured incorrectly.
Yeah.
Deductible and non-deductible debt. What's the priority and how do you go about paying it off?
Yeah, so non-deductible debt is the priority because, like we were talking about before, we were talking about after-tax returns.
Just so everyone knows, non-deductible debt in our world is called bad debt. Okay, so bad debt, there you go.
Thanks, mate. Yeah, so essentially, we look at it same way as we look at investments. It's about the after-tax impact, not the before-tax impact. And with that deductible debt, especially with investment loans, the interest rates usually work out a little bit higher, but you're getting a tax deduction on that. So the net or after-tax cost of those loans is generally cheaper than the non-deductible debt. So ideally what you want to do is, if you have both, you want to pay off the non-deductible debt as quickly as possible, and then pay off the deductible debt once that non-deductible debt is paid off. A common strategy that we use is moving the investment debt to interest only if we can, because then that frees up more cash flow to then be able to use that to knock off the non-deductible debt quicker.
So yeah, so you want to be smashing the deductible. So you want to be going through the process of high interest rate non-deductible, low interest non-deductible, high interest deductible, low interest deductible, in that kind of order.
Yeah.
Another question I get asked is around blending debt with investments. Now, we've talked about your choice in the matter around figuring out the 20-year goal, reverse engineering that, and then figuring out that they can get there or not get there, and then tweaking what needs to go based on the numbers, and then practically working about where they sit in that kind of financial literacy and behavior, and then allocating to then build up their behaviors to get to the point where they're really optimal humming. So they've reached the peak. And they want to accelerate things. Using debt can be a leveraging tool to accelerate your debt. How often is that used bar in investment properties? Like, how much is it used in regards to fueling that for shares and whatnot?
Yeah.
Using things like debt recycling. And why do you use it, and when don't you use it with people?
Yeah, it's an interesting one. So it's a very high risk strategy, because what we're essentially talking about is using the debt you've already got, taking on more debt to then be able to invest more money into an asset that's producing cash flow, and then using that cash flow to pay off both these debts quicker. So it is a high risk strategy. But yeah, I suppose the cases that we would do it is it's definitely someone that we want to have worked with for at least 2 years, because like we spoke about before with starting small with investing, if you are doing something big like this, you really want to understand the person and how they think about investments, how they react emotionally and all that sort of stuff. So that's number one. Number two is around their risk tolerance. So how much risk can they actually tolerate?
Or sleep at night and
sleep
become comfortable with, yep.
Correct, yeah. And the other one, again, is around the goals, because our job at the end of the day is to help clients achieve their goals while taking on the lowest amount of risk possible, not the highest amount of risk possible. So it's there as a strategy to use to accelerate these things. But if the client's in a scenario where, they're looking 5 years towards retirement, you don't want to take on more debt to potentially push out their retirement goal if that client wants to retire in 5 years' time.
How often is it used, JK? Because in the way I see it is that using leverage is the last lever we pull on. First one is elevate income.
Correct.
Second one, drop expenditure. Third one, revise goals. Fourth one, leverage.
Correct.
But let's say we've exhausted all them and we use leverage. How often do we have to resort to that lever?
Not very often. There's hard to put a number on it, but it's definitely one of the...
It's rare.
It's a rare strategy that we do, yeah.
Yeah, and it's not to the fact that we don't want people to accelerate their wealth. It's a matter of, do you need to speed to get to the destination? You don't need to, so why?
Correct.
And so we use it probably obviously more commonly in regards to investment properties, where you've got a big asset that you need to buy and you need to use leverage to kind of get into it.
Correct.
However, when it comes to the stock portfolios, it's rarely used unless you've met those criteria and you also have the understanding of the numbers. Because when you're paying debt at, say, 7%, you've got to make sure that you're earning 7% to at least get the cash flow to then support that.
Correct.
So then you've got to get to a level where you've got good enough cash flow to be able to support that debt repayment. Number one, have the risk tolerance to be able to cope with, you've put $500,000 in of debt, market goes down by 20%, your portfolio is now, call it 400 grand, but you still owe 500. Stock markets are very volatile. We've had a few good years of late, and I think people have like this, have a few good years and forget about just what happened in 2020 or whatever in regards to COVID. There's a lot of tick boxes that we don't see, especially in the early days.
Yep.
Yeah. And I think we need to be honest, is until you prove to us as in a client's perspective that you're capable, is then when we unleash these more advanced strategies for people. So hopefully that has been useful in regards to debt and investing and the way we kind of think about things.
Thursday, the 1st of August.
There's Siri as well too, wanting to get involved on the podcast. It's interesting that the way that obviously we think about debt and investing, and it's interesting about the way that people kind of think about debt and investing. However, there is not a one-size-fits-all approach. Every single person that we do and we give advice to, we do different plans for. And I still have yet to see one in the last kind of 2 decades that is exactly the same with every single person. The philosophies we use are there to risk mitigate, to ensure that our clients get to where they need to get to with confidence and clarity. But for you who's watching or listening, it's not just going, hey, I'll run with this and just give it a go. Giving it a go, you're putting your financial future at chance.
And it's a long-term strategy. So if you get it wrong, you don't go back 1 or 2 years, you go back 10.
Yeah, correct. And so we want to get this right. We want to plan. We want to, plan, strategize, execute, and then adjust along the way. Because, you might have implemented a great plan when, say, interest rates were low, markets are rallying, cash flow's good, interest rates go up, and all of a sudden you're in a position where you need to kind of sell assets because you've taken too much debt on. And we're seeing this in 2024. We're often seeing people come to us to work with us, and they've told us about them selling their property because they didn't forecast and plan for their financial future. So understanding what to put into your cash flow, into your debt, what putting into your investments is a very, very important thing to do. And hopefully today has been really useful to get an insight into how we think about doing it for our clients. JK, thank you very much for joining.
Thanks,
and
mate.
I'll see you all next time. And don't forget, if you're liking these, subscribe to our YouTube channel and make sure you follow us on all of your major audio platforms. Have a good one. Cheers.